Hello and welcome. You're joining us live from the 10th annual JP Morgan India Conference, and I'm here with my colleague Sajid, and we are in conversation with Latika Chopra, Executive Director of India Consumer Research, to talk all things FMCG, consumption, and the biggest question, Latika, first of all, thanks so much for your time today. The big question today, GST impact, the announcements that we've heard, big beneficiaries like autos, insurance, and FMCG too. So your first take on what the impact could be in terms of staples, discretionary, where could we be seeing an increase in spends?
First of all, thank you for having me on the show. Yes, clearly, GST could be a significant consumption boost, and clearly, our sector has been going through a rough patch. Growth has been fairly underwhelming in the recent years. For a variety of reasons, and clearly, this does come as a positive boost. The impact, is going to be felt across the board, and particularly the sectors that you mentioned, will certainly benefit. Within the broader consumption cohort, we still feel that, discretionary will probably fare better and probably see the cuts being more significant. When you look at the percentage cuts, the absolute amounts will look bigger. And this, supported by the festive boost that we are anticipating, the growth recovery could come sooner for the discretionary cohort. Low ticket discretionary, particularly footwear, apparel would be the beneficiaries, but I think we are hoping to see bigger discretionary products, particularly durables, air conditioners, large TVs, and even the other durables would have a positive rub-off impact, benefiting from these rate cuts. On the staple side, we think Q3, which is the December quarter, would be the first quarter where we're going to see what kind of a volume boost we start to see. I think the impact is going to come a little more with a lag, and it will be a lot more gradual. It will probably benefit categories where we have seen the price cuts sharper to benefit sooner or better or more relatively. So packaged food categories, particularly where, the salience of price packs is more, where consumers are generally used to consume the product in one go, could benefit from volume grammage increases that could come through. Of course, if a consumer is saving something, they can also spend it on other categories. We have seen many companies, advertising the price cuts so much across different mediums, clearly motivating consumers to come out, induce them to spend more. So the impact is going to be varied, but we think every category could benefit to an extent. But we are hoping that Q3 would be the first quarter where we start to see clear signs of volume benefit.
What's the kind of impact that you see on the volume part? Because you spoke about the fact that grammages is going to be the first thing which companies are going to increase, because it's not going to be the price points, especially 5, 10, 20 rupees price points, which are the most sold in the market. If that is the scenario, you're going to see some kind of volume uptick in at the end of Q2 and maybe Q3, as you said, it's going to be spread out.
Yeah, sure. So again, there will be certain categories, like, say, biscuits, where you're going to see the salience of these price point packs is significantly higher. Maybe over half the category it comes from these kind of price packs. Similarly, for chocolates, certain sections of soap, certain sections of toothpaste, they are sold in price packs, right? That quantum could vary anywhere between 20% to 50%. I think as we see the existing, packaging materials getting consumed, eventually I think companies would like to keep these price points. That would imply more grammage increases. So that's one way to think about it. The second way to think about it is that there would be a price demand elasticity, at least for the categories which have seen very sharp cuts, right? That could induce higher penetration, more frequency of usage, and that also is an enabler of volume growth. The third thing would be, in certain categories where we have a lot of unorganized competition, the branded players will see more competitive pricing. So that can actually enable some sort of market share gains also over time. And last but not the least, I think one of the benefits which we also saw when, GST was first introduced in 2017 was premiumization. Clearly, this step could encourage premiumization as, premium SKUs become more affordable. From a volume growth standpoint, if you see, Sajid, even before GST came out, if you look at FMCG companies in particular, you started to see a build out of stable, gradually improving volume growth, right? So if you look at the June quarter, most companies had already started to see rural starting to trend better, right? Urban has been a cause of concern. We still do not have very clear signals from the urban side. But if you look at the volume growth momentum, it started to improve. Of course, I would also like to call out there are companies who tend to do better because they are trying to do more beyond the obvious, which means, they're looking and taking a review of their current portfolios, looking at their legacy portfolios, looking to diversify. What better can come out of the new things that they can do, right, to revive growth, to drive and, move from single-digit growth to double-digit growth. So you're going to see that variance of volume growth delivery, but at a broader level, we do think, low to mid-single-digit volume growth that companies have seen to improve towards mid to high single-digit volume growth in the second half of this fiscal. So we are cautiously optimistic on FMCG space, but we are also mindful that you need to differentiate between companies. It will be a divergent performance, and investors have to basically make their picks accordingly.
So rural is coming up. You have issues coming up in urban consumption. You have the tax cuts and now the GST cuts. Is that not an enough indication or trigger for the urban consumption to start, or what's preventing it to come up?
Yeah, so of course, there were income tax cuts. Food inflation has been soft. There have been various state government stimulus, but if you look at income tax cuts and you compare it to GST cuts, are more spread out, right? Clearly, that is like very tangible benefiting the overall consumer base. One could say income tax cuts benefited certain sections more than the others. So yes, we are hopeful, that adds and, takes off some pressure from urban consumption. But we are also mindful that there are challenges on wage inflation, employment generation, which are probably hindering this growth on the urban side. As I said, we're hoping, large ticket discretionary is going to do better. And hopefully, if festive plays out well, that will be an added booster to the growth rate.
Right. So GST largely expected to affect the discretionary space, but what about staples? Because we've seen staples go through such a lull period for such a long time now. What about volume recovery? Because on one hand, you do have revenue expansion happening, but margins, they keep shrinking. That's the trend at least we've seen for the last 2-3 quarters to come. So do you believe this GST cut could finally move the needle for the sector, or more internal rebalancing or innovation is required?
Yeah, no, that's a good question. So, to take your margin piece first, and then I'm going to come to the GST thing. I think one of the key investor feedbacks we keep getting, over the last few years since, FMCG sector has not done well is our company is actually over-earning. And if you look at the last 1-2 years, companies have actually, started to prioritize revenue growth a lot more. Whether it's the pace of innovation, whether it is, partnering with the new emerging distribution channels, I think they have cared more for the top line growth at the cost of margins. And I think that's a welcome move, because what you need is revenue growth momentum coming through, right? And I think they are in the right direction. And some companies are doing this better than the others, but broadly speaking, whole focus is on revenue growth. And I think that's going to also benefit, stock valuations eventually. On GST side, I think companies, if you look at the initial price cuts that every company has announced, I think they're willingly come out and, extended those benefits entirely to the end consumer, right? So clearly, again, here the bias is towards, passing on the benefits entirely to the consumer in the hope that, demand is going to come through. Coming to your point, on how to differentiate, I think that depends on how companies are going to frame their portfolio strategies. It's just not from a very near term. I think it's more about thinking about next 3 to 5 years. How is the percentage salience of my portfolio sitting in categories which are probably going to be structurally double digit, which are going to cater to a more aspirational consumer, right? Where, profitability markers, work in my favor. Do I need to do it organically? Do I need to do an M&A? I think those are the considerations which, companies who are more agile have to take over. And that's going to differentiate, which companies are going to clock mid-single digit volume growth and which companies are going to clock high single digit volume growth. And I think the second piece is, competitive intensity is going to stay stiff in this category, right? India is a market which attracts everybody. You continue to see new brands emerging, I think, every other day, if I may say so. And the other bit that companies have to deal with is the evolution of distribution channels. So I guess the agility on both these fronts is also very necessary to see how companies balance this revenue growth and margin equation. But I would like to think, if a company is going to deliver strong revenue growth with stable margins, I think that's a good outcome. Having said that, for FY26, we are actually going to compare against a very benign margin base for most companies. So I think this year, hopefully second half, we will start to see some bit of stability in margin to some modest improvement in margins as well.
Look at valuation in that context, because valuation has tapered off from the peak, but it's still much higher for many of the FMCG companies. And when you're talking to investors, how are you justifying the higher valuation relative to Asian peers and others?
See, you are absolutely right. So of course, the sector has also gone through a period of earnings downgrade, right? So we think we are coming towards end of the earnings downgrade cycle. If you look at the last 3 to 6 months, I think the quantum of earnings downgrades that the sector has seen has actually already started to moderate, right? Now we are not saying that valuations are going to expand from these levels. I think stock performances or stock returns are going to largely track the earnings growth trajectory. So the biggest catalyst which investors and us are going to closely watch is the trajectory of earnings growth, right? If we see that the earnings growth trajectory is improving, or there is a potential for earnings upgrades, I think those stocks will basically stand out more to investors.
And within your